All right, we are live with the one and only GlobalFlows. It's finally time that we connect with him and have a conversation, talk about macro, talk about the differences between our processes. We do have some similarities. I know GlobalFlows, you also are very systematic, but you're also discretionary. So that's a bit different. We run fully systematic with our models. So, can you give us a little bit of a breakdown on what your process is like? How do you go from A to B on having an idea and to placing the trade and then to exiting that trade?
Yeah, so what I would say is there's probably a couple different levels to that, and I'll try to simplify it a little bit. But what the way I think about it is there's some decisions that you want to make with a systematic approach, and there's some decisions you want to make with a discretionary approach. And I think that there are certain domains that I don't want to implement my discretionary decision making, right? Like I don't want to be the guy who is doing math on his own when I can just use a calculator, right? And I think there are other places, whether it's because of too much complexity or whatever the reason might be, where I want to use discretion because it's going to be very challenging to synthesize all the moving parts, even if we use some type of multivariant model or machine learning approach or something like that. So what I do is I pull together all of the time series in markets and go through every single data point for economic data, financial market data, break all of those down, model them, try to connect them on an outright and cross-sectional basis. So just simple example is I'm looking at equities on an outright basis, bonds on an outright basis, and then also the relationship between the two. And then, connect that to economic data. And I basically have a process that pulls together and synthesizes and weights all of those things. And what I try to do is I try to isolate each relationship that I believe exists and run it through, a machine learning model and then also some AI models to connect it to some like language learning stuff or language learning models to connect it to some views, whether it's from language in the market or just other views that I have. And the net result is me trying to isolate relationships, backtest them, have some type of statistical predictability behind them, and then use those models to in a preset discretionary process. So if I try to backtest a couple of relationships, those relationships in themselves might not hold monetizable value because their expectancy might be low, right? Or negative, it might have a negative expectancy, which just means that over time it might lose money. But
Right.
understanding that relationship can still be very valuable, right? If you just kind of think about if you're, a lot of people these days are trying to run multiple low sharp strategies or something like that in, some other process to create some type of diversification approach or something like that. So, I'm really about how can I break down every moving part, quantify it in a way where it doesn't lose signal, because I think a lot of times systematic just becomes trend following, right? Where you just are modeling data into signals, but you miss turning points, right? Or you just are trying to capture the large portion of a trend or something like that. And so, my whole goal in how I connect that to trading is I think about price and the trades that I take in terms of quantifying a time series with momentum and mean reversion. So is this thing trending? Is it have higher returns that predict higher returns? Or is it mean reverting, which is, let's just say it's chopping in a range. Like that's all that, the way I think about momentum and mean reversion is it's temporally dependent. And then also you have, if the price goes up, momentum says it predicts a higher price. Mean reversion says the opposite, that it's going to mean revert back down. So
Understood.
I I think about the trades that I take is I'm betting with or against momentum or betting with or against mean reversion. And if I'm betting against momentum, for example, if I try to short gold right now, that probably has a lower hit ratio, right? If I've been trying to short gold every week this past 3 months, that is a very low hit ratio because I'm betting against momentum. And so I would need to have some type of informational edge to bet against momentum with the expectation that um, the return that I make, offsets thing. I'm not short gold, by the way, just to be clear. But
Oh yeah,
uh,
no.
Yeah.
but so that's how I kind of approach it, right? So I have that in terms of macro. I really start with short-term interest rates, model that across the curve, connect to FX, model risk premiums in just the risk curve for sectors and factors, and then kind of connect those all together to the yield curve and risk curve, and then trade that in real time with kind of the things that I laid out before. So I would say that's kind of like a baseline for my approach. I'd love to hear what you guys think about that, or how you guys approach it differently.
Yeah, so I think that the interesting thing about us talking on a podcast here is we kind of have the same approach, except you seem to tie things a bit more together dynamically through discretion, or at least partial discretion, where we have a growth in inflation model, a system that measures impulses within the market, and we
Yep.
use these impulses to define trends for growth and inflation, which are irrespective of the Nasdaq or the S&P 500 trends or small
Right.
cap trends, right? So these give us like a first layer approach to where are the macro impulses going, and then based on what these outputs are, we risk inflation, expansion, deflation, stagflation. We
Yep.
quantify them into two simple risk buckets: either risk on, risk off, right? And in a risk on regime, we want to be long risk assets. In a risk off regime, we want to be long risk off assets. So
Right.
we take the signals that are quantified from from these impulses, and then we
Yep.
measure them against how equity trends are, how bond trends are, how gold and healthcare, utilities, etc., how they're trending, and we look for double-sided confirmation where the macro regime and the trend line up together for the trade to take place. Otherwise, the confidence is not high, and we end up in a situation where we're basically, either you're fighting the macro regime or you're fighting the trend, and that just doesn't work.
Right. Totally. You guys find that the economic data that you use to model, those kind of quadrants, how do you feel like you find that additive to the trend signal that you might decompose from assets? How do you think about that relationship?
Well, the relationship is a bit it's dynamic in the fact where the the system is what we call this may not always lead a trend, or in some cases it does. We
Mhm.
found that the system actually has a higher success rate of leading risk off pivots than it does risk on pivots, meaning it'll be slightly delayed to a risk on pivot, but it'll be a little too early to a risk off pivot. But given that we're able to somewhat control risk asset drawdowns and risk on regimes by being somewhat early to those drawdowns, and we're able to
Yep.
leverage up the beta, right? Some would call it alpha, but it really just leveraged beta selectively, which over
Sure.
time generates alpha, right? You can't just leverage beta and then call it alpha unless it's selective um, over a long enough time frame. And that's pretty much how we see it. We see that the wider we make the scope for the system in terms of data releases, and the more infrequent the data releases are, meaning the lower frequency, the more
Right.
noise gets imposed into the model. So for us, we try and stick to the most high frequency data available, and we pretty much cut all low frequency noise, because that, GDP last week coming out for quarter 2
Sure.
is irrelevant, right? So having something like that sit in a growth impulse model is actually dangerous, because Recessions happen. Not that we're in a recession, obviously, but recessions come in a surprising fashion, which is why most people are not able to foresee them. So if
Right.
you're focusing on stagnant data or low frequency old data, you're setting yourself up to basically get, be off sides significantly at any point in time.
Sure. Are you guys typically running a portfolio where you change the weightings, or are you doing absolute kind of absolute returns, kind of more of a
Yeah, no,
focus? We're doing a bunch of one-off trades, or how do
yeah,
you think about that stuff?
we don't really scale the weightings is in terms of, are we gonna size up and down our risk on exposure? We're pretty much set it, forget it. But what we do is we rebalance the allocations quarterly against, for example, at the moment we're long Nasdaq with leverage, and we're long Bitcoin with leverage. And today is the end of the quarter, so we're going to rebalance the allocations into the close. And as if you, as everyone probably knows, Nasdaq did real well the last month or two. Meanwhile, Bitcoin has not. So Bitcoin exposure is going to go up with Nasdaq exposure going down with the rebalance here into the quarter end. So that's pretty
Sure.
much the sense of how we alter our allocations. We don't necessarily. I know some people find it, in certain models, successful to take something like implied volatility scaling or whatnot, where you can dynamically shift the weightings of a model to not forecast price returns but forecast volatility.
Sure.
And we found that that works if volatility is not artificially high. When volatility is artificially high, what ends up happening is a lot of these models are not adequately long risk, because, like, if you look at VIX, and if VIX is at
What do you mean by
16,
artificially high? What do you mean
like
vol is artificially high?
what I mean is, if over the last like 15 years, VIX
Sure.
at 16 would be something that is not necessarily, it's low, but it's not necessarily what it used to be, right? Pre-COVID, VIX 16, that was the upper end of a vol spike.
Right.
So if you're filtering for vol, or your vol targeting is not dynamic enough, where you're using fixed weights from a pre-COVID environment, what ends up
Yep.
happening is volatility is essentially, on a pre-COVID basis, volatility is actually somewhat high right now. But on a post-COVID basis, this is actually somewhat low. So how the volatility filtering is taken up in your model will in respect change the allocation to the point where you may under allocate risk, because volatility is pricing in um, a confusing signal of it being somewhat uncertain.
Yeah. Do you think about it? Do you think about it more as wherever we are on a trailing basis for whatever your look back is, as opposed to like the level compared to 4 years ago? Or how do you is that kind of what you're saying?
Yeah, well, what some people like to do, I guess, to add some clarity to what I just said, some
Yeah.
people look at vol as buckets, right? They'll say like, okay, VIX over 15 is a regime bucket, or is a sizing bucket. VIX over 20 is a sizing bucket, etc. Right? Like, the issue with that is, I think that if you look at just political risk coming into 2025, given the new administration, the new administration themselves are a vol enhancer, right? So they lift the curve of volatility just because of the level of uncertainty. Like, anything can happen overnight, basically over the weekend, right? So vol is going to perpetually have a stronger bid than it would in an environment where, say, there was less political influence or less political pushback. And meanwhile, we're talking about VIX sitting at 16, 17, but the markets continue to rally. So it's not so much like, if you have again, going back to your filtering process, if it's not dynamic enough and you're trying to use implied volatility to forecast, um, trying to use implied volatility to gauge future volatility, meaning if VIX is high, it can mean revert, right? If
Sure.
VIX is low, it can mean revert the other way. Um, if using this as a signal, depending on your filtering, if VIX gets to where it is right now, 16, 17, that might be a normal functioning market, where you may be putting on, you may be thinking, okay, we're going to mean revert one way or the other, and you may take down sizing just because of the high level of implied volatility.
Sure.
Right.
Yeah.
Now, on the other side, the high IV, the 16 VIX, right, is going to introduce more volatile returns regardless. But what we've been seeing is a higher baseline of VIX in 2025, but also outside of that 2025 Liberation Day shock and Q1, returns have been outsized to the upside as well. So it's not like VIX is hindering, or high IV is hindering market returns.
Yeah, I mean, I guess I would think about that as I mean, I don't necessarily think we're in a low VIX environment. I guess 16 compared to 12 or something like that. I think a lot of that has to do with the microstructure of the market and what we're seeing with just hedging flows, because it's very possible that we're just in a, let's say, a higher than 15 VIX environment just because people are paying more for hedges than they did in the past, right? Or people are using option flow as a form of leverage, and it's just like higher premium for calls or puts, right? Overall.
Right.
So I guess I would think about that. But I guess I think about in terms of vol, I think that, I think about volatility as just a way that you're characterizing price, right? And
Of course. Yeah.
I just think about implied vol as, it is just another way that the market is pricing the distribution, right? Because I think about, if you have a momentum or mean reversion, regime, it is not only in itself pricing a probability for more upside or downside just in its technical nature, but then also the vol side of that, whether it's with implied vol premium or call skew or put skew or whatever it might be, is pricing additional changes. And so I would say for my thought process, it's very challenging, I would say, for me to come up with really banger trades that have significant edge by just modeling price. That's what I would say, or just modeling economic data. I think that I've found a lot of challenges just building models based on the time series alone, because I think about every trade that I do, and I think about what is, every major quant in the space. I mean, just systematic guys, right? Just in general, you're extracting a certain premium, right? And I think
Yes.
there's this spread. It's not good or bad. There's just a spread where there are certain, if you're going to a certain way of extracting returns, you're modeling the time series and the how would you say it? I think that I'm trying to always figure out what can I not know just from modeling the time series alone. That's what I always ask myself. So if I am, the opposite end of the spectrum of you guys is, I'm always thinking that like the systematic space is so large, right? Like the amount of, capital, and especially with the quants and the amount of trading and volume and everything else, right? And a lot of the time, those guys are primarily based off of, or I would say the majority of the time, just based off of modeling price, right? They're always going to have other things here and there. I think there's a lot less people that use economic data in kind of like the quantamental approach, because I think people are just using, the catalysts these days, right? Where they're just saying, you know what, I don't even know or care what inflation is doing. I just know that my returns higher or lower after a CPI print have predictability for where we can go with returns based on like a stock bond correlation regime, right? So I feel like a
Right.
lot more people these days are not even basing things off of underlying information, and they're more basing it off of, just the efficiency where, the returns around FOMC after the close or the day later or the Thursday or Friday later, and they're saying, okay, that's higher. So now I know that's a support zone or something like that. And then they say, what's my correlation between that? what's my stock bond correlation, my FX correlation, my vol correlation through those events, and then using those kind of signals as these um, higher signal zones that have shocked this complex system to provide more predictability about returns that are going to have some type of significance on a forward-looking 7-day or 10-day basis or something like that, right? I have not found I found help in those. I think there's a ton of help in those. I think that it's a critical part of the process that I run and think about a lot. I've just found it very challenging to I'm always just trying to think, what is a view that I can have that I wouldn't just have? How do I have predictability of the time series, not just by looking at the time series, right? And I think if you're going to go down that route, then you are basically, you have to go into that discretionary realm, right? Because there's this,
Absolutely. There's no way to do it. Yeah, you can't if you're trying to go one step further, it's impossible for you to come to a conclusion without putting some um, I don't want to say emotional, or let's just say intellectual influence into the equation.
totally, totally. Yeah, I think that there's a huge benefit in the systematic side of what you guys are talking about, because you have a little less emotional involvement and you are able to think a little bit more clearly in some aspects, right? Because you kind of have this like pre-made process, you have all your weightings preset, and like typically, especially for systematic, unless you're like selling tails, like if you're having um, like a bad month or a bad quarter or something like that, it usually takes place a little bit slower, right? And
Right.
I think that that kind of allows you to have this like clarity and foresight as opposed to like making a mistake, beating yourself up, right? And then having to come back and come up with an idea when you are maybe a little bit more emotionally fatigued, right? So I think there's so much space for both, and so much of it, lends to like, okay, well, who am I as a person, right?
That's also true. I mean, some people, I think the systematic space has obviously grown exponentially in the last, let's say 15 years. But
Sure.
I think the key there is a lot of like there's a exponentially declining, you can call it advantage, or I don't want to call it advantage, an exponentially declining like barrier to entry in systematic approaches that are inversely correlated to time. So the the shorter you are in the market in terms of frequency, the higher that bar is to succeed, because you're fighting you're fighting quants that literally have $1 billion of R&D.
Right.
um, and you're not going you on a trading platform with Wi-Fi latency are not going to compete with that. It's just not going to
Right.
happen. And I think that a lot of the systematic hype has been around this high frequency arbitrage trading, where you don't necessarily need to take duration risk, right? Which enables you to generate these high like super high sharps. Um, but at the same time, those strategies get exploited and arbed away over time. So that's why these quant funds have significant investments in research and developing new strategies, deploying and taking off, putting new strategies online, taking old strategies offline to keep their edge intact. And some strategies, remain more persistent than others. And I think the longer you go out in time, the higher your odds rise that you are not going to be arbed away so quickly, because you're moving from you're taking a systematic approach that's really focused on high frequency. You're not really holding risk overnight, to something
Right.
where you're taking duration risks now and you're competing with the longer term investors. And that's where I think that there's probably a fine line in there. And I think our different processes kind of show that there's no real perfect way to do it, but there are many ways to get this done, where you can get a systematic approach that carries over from some of that short-term alpha that these quant funds are using, and throws it into the pit where people are fighting, in an environment where they're arguing about 4 PE ratios. So
Yeah.
you kind of have that edge where over a long, you obviously go too far out. You go way well beyond the risk, well beyond the time horizon curve. Now you're just talking about buying the market. Like if you're talking about a setup over 10 years, you're basically just long the market at that point. There's no, like if you're making 10-year plans, like at that point, just long the market. But if you're trying to be in that anywhere from 6-month to 12-month timing, I think that the quant firms haven't allocated enough resources there because they're not advantageous. Those strategies are not advantageous to charge the 2 and 20 pluses that they do, because you're essentially long beta at that point. You're long the market, and there's no the correlation of returns actually deviate away from being non-correlated to being more correlated to the market. And at that point, you're you're just running you're just running a hedge fund at that point. You're not really a quant shop or a pod shop.
Yeah. How would you think about if you want to move out the time preference risk curve and take have a time preference that's higher than, shorter term players in the market? If you want to do that, how do you think about that? If I would say the main reason a quant fund, well, I don't want to speak to those guys because I would also say that there's a lot I don't know about every single thing that every major quant fund does. But what I would say is that, most of the time it's connected to the fact that having predictability over a 2-month time horizon is it just, your predictability just collapses, right? On a
Of
systematic
course.
basis,
Of
right?
course.
So how would you think about if you're going to move out this, let's say, spectrum of time horizon where your on a systematic basis where your predictability is
Right.
collapsing, but then you also have this other side of the time horizon where you're just doing beta and rebalancing. And how would you think about, for you guys, like providing value and extracting returns from the market in kind of like that sweet spot where you're not just managing beta, or I don't know if you guys are just managing beta, which is totally cool, but managing beta versus not competing on an HFT basis?
I think the
If
first
that makes
scope
sense. If
there.
that question
Yeah,
makes
no,
sense.
no, I got you. The first scope there is we don't really like the intraday price action is to us is noise, but this is the difference because those high frequency quant shops, they feed off of that. Like Citadel doesn't make money 6 months out, right? Citadel's focused on intraday, right? Their systems are designed for high frequency. They're not sitting here. I mean, not that they don't, but they're not sitting here trying to figure out if the spoos are going to rally, 600 points over the next 6 months. That's irrelevant to them. They're trying to figure out how they can um, basically arb the market today, which is pretty much what these pod shops are trying to do, most of them. And the further you got in time, the less predictability is what you is the true fact. You do not have the same level of predictability as you do on a shorter term time frame, like you just said. And
Right.
this is where like I think it's important to note that having the systematic approach really comes down to trending markets, because if you do not have a trending market, and I think you said this earlier, which I'll tie this back to, if you don't have a trending market, you essentially the time series becomes stationary, right? Where you're just mean reverting up and down, and that's
Right.
probably a systematic trader's worst nightmare if they're not high frequency. That's probably a situation where
Interesting.
returns flatten, right? And you end up in a situation where you're you're looking for those long term, which you said earlier, those momentum signals that are breaking out, but they're actually there's no momentum signals. They're just all mean reverting signals. And you're looking for a trend that never persists. And then you end up in a situation where you're chopping up capital, waiting for a trend to break. So I think that given the United States, and obviously this doesn't work in all markets, right? You need a market that's trending, and you need a market that has a lot of liquidity, because if neither of those are true, you're going to end up in a situation where one, low liquidity over a long enough time horizon is substantial risk, because you're introducing the illusion of low volatility when if the markets can move 5 or 6% rapidly, you're on leverage, it'll smoke you. And if they're non-trending, then you're essentially just letting volatility drag eat you alive. So I think that the systematic approach on a longer term time frame has weaknesses, especially if markets are non-trending. And I think that was a big risk that everyone saw in 2022. That was a perfect example because literally nothing was trending outside of commodities in 2022.
Yeah, interesting. I think well, there's a lot there. I think that, and I know I gave statements that there was a lot there too. But what would you guys say that like what is the specific place that you guys feel like for you guys in terms of like how you're running risk or your trades or your portfolio and stuff like that? Um, how would you think about where you fall on that spectrum and what because are you sorry just to clarify, are you guys trying to generate alpha, are you guys just trying to manage beta, or I mean those are for some people just semantics, but how would you guys fall into that category, and then how would you guys think about falling on that spectrum that you talked about?
Yeah, so for us, I mean, we're not looking like our optimal portfolio is or our strategy is something that has similar drawdowns to SPX but on leverage. So we're leveraging beta. So again, semantics, like you said, some people will not consider the returns alpha if you're just leveraging beta, but we selectively leverage the beta and then we go to cash or risk off assets in different regimes. So in
Yeah.
risk on regimes, we're just leveraged beta. In risk off regimes, we might be leveraged bonds, we might be leveraged gold. And the culmination of all these returns generates outperformance over time, as so we've seen. But we're not necessarily out here looking for non-correlated assets. We want, and I think that's a big thing that a lot of these funds, a lot of these long short funds, they suffer in strong, robust bull markets because that's when you want to have correlation. That's when you want to have as much beta as possible. It's when the crap hits the fan that you want to be not correlated at all. And I think that's probably what ends up hindering some of those returns over a long enough time scale where a lot of long shorts don't look so attractive.
Yeah, and I think that's where
Yeah.
our system shines, where it's really good at predicting risk off events. So just being able to reduce that drawdown allows us to be able to lever up during risk on regimes or even during risk off regimes because it's so accurate at predicting risk off regimes. That's really what it's best at.
And do you guys feel
Uh,
like is that primarily from merging the economic signals and time series, or is it
Absolutely,
more,
absolutely, yeah.
is it just
You,
managing, is it when kind of vol expands too much or too fast that you guys begin to scale out of like leverage and represent a regime shift? Or how do you guys
well,
think about why, you don't have to tell me the signals, but why do you feel like it catches the downward moves more than the upward moves? What's the source of that?
well, there's two things. So like if we just take a look at the Nasdaq, this is
Yeah.
our trend model, right?
Yeah.
And the way our model works is two ways. For us to be along the Nasdaq, we have to be in a risk on regime and not in a bearish trend. So if we're in a risk on regime and the trend goes bearish, we close our leverage longs. If
Yep.
we're in a bullish trend, but the risk regime goes risk off, we close our longs. So there's two filters actively working to keep us in and out of positions, which I think using a time series only, you'll run the disadvantage of essentially either not catching a macro regime shift from the data or you're delayed via price. So if you're just looking at one or two things, like if I just look at the macro regime data,
Right.
the trend may shift, markets may move before data is like impulses flow through. And
Right.
at that point, you could be, a mid 15% drawdown in the indices, and then the data starts falling apart. And that would deteriorate the signals there, and vice versa. Perhaps the underlying macro data is actually weakening on the surface, but they're still bidding equities and there's a signal there. So I think the double side of both of those signals combined allows us to at least moderate our drawdowns to a degree where we can leverage up beta in risk on aggressively and scale back in an environment where risk is not so attractive. Like for example, we would never, no matter what the risk regime model says, we would never hold the NASDAQ all through 2022. Like it just wouldn't happen because the trend would have us out if the regime didn't, vice versa. And the downside is interestingly enough, is what you said earlier. The downside is that we tend to not catch actual structural market pivots. Like the odds of us, just given the way that our system goes and being able to time risk off a bit earlier, allows us to somewhat sell near the top, but buying absolute bottoms is not something we don't claim we can. We don't try to. It's not something that we've seen or had much luck doing, because for us to buy back in after a risk off event where markets are trending down and impulses are bearish, both the trend and the impulses have to go up, and typically one of those is moving first if it's one or the other, and we have to wait for that double confirmation, which does add lag. So it's a bit the system by design is almost a bit more hesitant to take risk by itself in terms of going risk on and then being weary of risk in the system and taking risk off. And that, I think, it allows us, at least on the surface, to pick up more leverage in a risk on environment without blowing ourselves out in terms of any type of negative surprise or swan shock that were to come.
Yeah. And is the regime model that you guys are using to go in and out, is that just based on this momentum model in TradingView, or is it also a combination of other models that you're running in the background?
Yeah, that's other models. So they're not cross correlated like that. They're not gonna. The models themselves are not going to, like. A good example is, just because the NASDAQ is bullish trend doesn't automatically add bullish trend growth impulses. That would be silly, right? Because what's the point of having a multivariable model if the same variable is just cross correlated?
Right.
Yeah.
So would the I guess what I'm trying to understand is, would the getting in and out of the S&P here or the NASDAQ be based on the script that you're running in TradingView right here, or is there another input that would make a decision for your actual position?
Well, it depends if it's a trend issue or if it's a regime issue. If it's a regime issue, we can get so here's a good example. In 2024, we got a risk off pivot here
Gotcha. Yeah,
on
so I was kind of curious. Like,
yeah,
will you go out in a green regime, in a momentum regime?
absolutely. Yeah, because
You'll deleverage.
we have to. I mean, we're running 3 times beta leverage.
Gotcha. So
Yeah.
and that'll be based off of the regime model that you have.
Correct. So the regime model here, and maybe I can go back 12 months. Does this go back far enough? Yeah. So here you can see in 12/30/2024, we were in stagflation, which, simply put, this is risk off. So risk off, slowdown, risk on. Slowdown has there's a blend between the two, and allocation wise, it's not significant. But we were risk off 12/30/2024, and we stayed that way pretty much the whole year, and the whole first quarter. And the risk off annotation here came on Christmas Eve. Now, the markets actually did nothing for a while, and this goes back to what we were saying earlier. The system tends to pick up risk a bit of, some would say, a bit too quickly, but it's important when we're using high leverage. We want those quick pickups, because we don't want to sit in a situation that the economic data deteriorates and we're playing games trying to say, oh, it'll recover. We'd rather cut risk as quick as possible and then leverage returns when confidence is as high as possible. And throughout this whole time, we were basically waiting to see either the regime flip or equities break down. If the regime went back to a risk-on stance, we would then just re-long equities wherever that pivot happens. But it didn't, and the market decayed. And then coming out of it, same thing. We got the bullish trend signal in May, but we didn't get the regime signal until June.
Gotcha.
June, July. So we again are not looking to time the bottoms, but we're looking to essentially isolate the periods of highest probability to leverage returns, because obviously you can see 3 times leverage randomly will not like on a long enough time scale, it will not work.
Gotcha. Yeah. Yep. So will you think about when you think about the process that you're running right now, does that typically have this? You said it has the same returns as the S&P, but less vol, or what was the kind of takeaway for outperformance for the index?
So the way that this works is maybe I can just show you the turns here. So what we're trying to do is we have two models.
Yeah.
We have our equities and or I should say our public market model that's ex crypto, which is Bitcoin, which is stocks, bonds, healthcare, utilities.
Yep.
And depending on the regime that we buy, that regime that we're in, it depends on what we buy. And our other model is Bitcoin. And the way that we look at this is if we can combine the models together over a long enough time frame, let's see if we can go all 2016 here. This is due to the inception of the actually, you know what? Bitcoin only came around in 2016 in terms of and that even then a bit speculative in pricing. Let's go back to just equities only since 91.
Yeah.
And this is the model that we're trying to here. Let's see. So this is the model where you do take. It's not like you don't take drawdowns. It's not like
Yeah.
you can't. This is unleveraged, of course, right? But the idea is, if you can avoid just some major drawdowns
Yep.
and lower that correlation just a little bit, and you leverage returns in tandem, you essentially can amplify returns over a long enough time frame where you're not necessarily running laps around the market. I mean, your Sharp is slightly higher, your Shortino is slightly higher, your max drawdown, on an unleveraged basis, this is unleveraged. So on an unleveraged basis, slightly lower. But the goal here is to develop a model with somewhat high confidence, but you don't run into the situation where you overtrade yourself out of alpha either, right? You don't want to have a model that introduces a lot of slippage, a lot of just noise at the end of the day on a higher time frame without predictability. And that's our goal. Our goal is to just isolate regimes and trends of high predictability,
Yep.
leverage them, and then scale out when the odds or at least future prospects don't look as good. And that's
Totally.
our model.
Yeah. I like it. I like it. I like the visual, man. I like how you guys pull it together and everything like that. I think that's super cool.
Yeah, I mean, you definitely have a different approach, which we appreciate. Like, I think that's why we've been so excited to get you on a podcast, is because for all this time we've seen each other go back and forth, and we almost have similar views. Like it's like we almost like are positioned the same way, but we don't have the same models, which is kind of cool.
Totally. Yeah, I mean, I think there should be like a lot of times. I forget who like said this, or even if it's a phrase or anything like that, but like smart money in markets kind of all executes at the same time, right?
True.
I think there's a lot of, people that will get in and out of trades in very similar periods of time. I think that like all the guys that I know that we talk pretty frequently. I think a lot of us have a lot of times similar views, and it's just kind of about the timing of those views and the execution around them, because we're like, oh, well, do we want to get long bonds here? And we're like, well, no, it's not something any of us are really thinking about until XYZ or happens or something like that. And then
Right.
kind of like same with a lot of different things. And a lot of it comes down to timing and execution, just because like the characteristics in markets are pretty, you know, I think pretty like well documented in a lot of ways. I think that there's a lot of edge in figuring out what is too complex to model and figuring out why, and then figuring out some type of edge that you can build into that. And I think that's kind of where we're at in finance overall. I think there was some article recently, DE Shaw or something like that. They just launched a new hedge fund that's
Discretionary, right?
only,
Yeah.
yeah, it's only
Yeah.
discretionary traders. They're not using any of these other things. It's probably just some bro with a Bloomberg, and I'm sure they might have a couple analysts or something like that. But I think there's a lot to be said about like if you understand how things are working, like that is how you're, making, exceptional returns because I think there's always going to be a signal in markets that's highly idiosyncratic and that is going to provide you with some type of information um, about where the trend is going that a pure standard deviation model or some type of special vol calculation or something like that is not going to show, right? And I think if you don't have that, like if I stopped trading markets tomorrow, I think I would just focus on having a different time preference or risk tolerance in the markets, right? And managing my beta a little bit instead of trying to do that because I think that's kind of an all-in type of role. It's very challenging, I think, to do that. It's incredibly challenging for me, and I spend all my time doing it nonstop, and I have, you know, a lot of money just going into the R&D process and, you know, uh, coding up models and, going through that entire process of, working with people and everything like that, and it's still incredibly challenging.
I'm
Yeah, I
curious,
mean,
what is your story? Like, how did you get to the point where you're building these models and to where you are now? What is your story?
My story. I've had a number of different people tell me I need to do a video that kind of breaks down everything. We'll probably do it sometime soon. But I would just
you're
say
not a
right
janitor,
now,
right? You're not a
what was
janitor.
that?
You're not a janitor, right?
Not a janitor. Well, theoretically, it's actually funny. I think I can't tell that story. Sorry. Yeah,
Don't worry about
the
it.
joke
Don't worry about it.
is I got to be careful what things I talk about online. But the joke is that I was a janitor at Goldman Sachs for a little bit. But no, I think that right now my role and what I'm trying to accomplish is I am extracting alpha in the market, and I am working with some individuals for that, and I am, trying to build up a better and better process in my own abilities and then also in the models that I'm running to have a much clearer and better read on interest rates and FX and all global macro and to have, some exceptional returns in there that are pretty world class. So that's the direction that I'm going. I think that most of the stuff to do all of that can be learned for free. And I would just say that, the where I'm at now is not like this far step in one sense, I think. Like right now, in terms of my, business operations, expenses, and stuff like that, I have a couple Bloombergs, one full-time employee, and then some other like data stuff that I pay for. Um, and if you're doing like I just think an exceptional job at trading and really locked in there, and you're able to build out these processes and systems and just even the mindset, even if you're not like a coder or anything like that, if you're able to build out the mindset for it, then you have a ton of upside. And I just don't buy personally. I just think all of this stuff around the industry that people go over about how they're telling you that you can or can't make returns or that oh you're constrained by beta or this alpha or that alpha, like I don't believe any of that stuff. I think it's ridiculous. I think the entire financial industry is kind of gotten filled with a bunch of consulting bros who have no interest in doing exceptional things in life, and so I just think that
Of course not.
I just think
I
there
mean,
you gotta really. I just think the entire industry, it used to be oh you want to work on the sell side because you had all these prop desks pre 2008 on the sell side, and then oh now everyone wants to move to the buy side. Now everyone's doing these pod shops and all this
It's all AUM. That's all it is. AUM and management fees. That's what this game has
Yeah.
become.
So I just, I am not saying that those people don't work hard or anything like that. All I'm saying is just I have no interest. I think the bets that exist in markets and just also in life are not there. They're somewhere else. So that's what I would say.
Yeah, it's interesting. You and what you're doing, what we're doing seems to be somewhat similar, which is kind of cool. Again, to have someone else in the space that is as aggressive and outgoing, which is again with a different mindset in terms of trying to either pitch one idea, you like a Bitcoin maxi, right? Just trying to say like long one product and that's it. That's all you need, or someone that's trying to sell a service where it's all about gathering AUM, right? No matter how much or how hard you really work, like you actually have to be, you don't actually have to have much in skill of finance. You have to have more skill in communications because your job is really just holding hands at that point. You're not really actually doing anything in financial markets. You're just putting people into vehicles and holding their hands and telling them it's going to be okay. And there's nothing wrong with that. There's an entire industry devoted to that, but I think that takes away from the uniqueness and greatness of what we're trying to do here.
Totally. Yeah. No, I totally agree. Very cool, guys. Well, I appreciate the conversation. I'm glad we were able to hop on a call and chat and everything like that. I thought it was really cool to kind of see your process more and hear your mindset and everything else. So I appreciate you guys taking the time.
Yeah.
Oh, Yillis, we appreciate having you on, man.
Yeah. Thanks for joining us on this.
Yeah, absolutely. Are there any other kind of final things that you want to chat
Yeah,
about before we hop, or any of the other kind of
yeah,
topics?
I do actually. So Artie and I have been going back and forth on this. Do you think we're in a melt up right now?
I mean, in what sense? What do you mean?
Like, so if you look at like some small caps, like especially like the hype stocks, you could, if you were to isolate your focus on hype stocks, you'd say, oh, this is a melt up. But then you look at broader range asset prices and you're like, are we in a bull market that's being masked as a melt up with subsector bubbles that are inflating and deflating, which is kind of my theory, but I'm curious to see how you see it.
Yeah, I will say that I don't necessarily subscribe to like stuff like bubbles existing or not existing or stuff like that. I guess that I think about it as I model sector and factor returns in the index and then also just kind of everywhere else. And I'm trying to, I think the capital is always shifting in where it's producing returns,
Yeah.
right?
Mhm.
So right now we have a lot of like for in the Russell we have a lot of telecommunications putting up massive returns. In some indices, like in Canada, we have a lot of materials and silver miners and gold miners putting up all the returns and stuff like that. So I think returns are always shifting, and I think that this I would say this period of time we're in is unique in the sense that the Fed and the government and also underlying changes in investment and in AI and everything else are fundamentally kind of shifting some of the structures of balance sheet and consumption trends.
Yep.
I mean, we always normalize to whatever it is, and I think that the level of liquidity that we have now is the reason why we can have a 20% return this year in the S&P, which would not be surprised if we have that. The reason why is because you have so many factors shoving capital into everything, and I
Right.
think that you have higher returns during those periods of time. And I just think about it as this is, I kind of like tweet about it and stuff like that, that the type of liquidity that we're seeing right now is very challenging to sustain without it flowing into inflation, right?
We
So,
agree there, I think. I think we have the same view that inflation has
yeah,
upside risk. Yeah.
yeah. So I just think about it as like that. I think that it depends on, there's this moment where even if inflation ticks up 200, let's say it ticks up 150 bips, right? Like core inflation ticks up 150 bips from where it is right now. Like if that happens and the Fed lets 70 bips of cuts be priced for 2026, and the dollar, gaps down another 5 or 10%, there's going to be a moment, especially with the amount of foreigners that hold U.S. assets, where either long end rates blow out, and if they try to shift issuance in the Treasury and the Fed together and pull that down a little bit, then or keep rates on the upside capped.
Right.
That is going to there's going to be a moment where the returns that you have in U.S. assets on a real basis, so like a dollar denominated basis, like a foreigner is saying, what is my return for the S&P, and then what is that after I convert it back to my currency, right?
Yeah, they're not going to be competitive anymore. Yeah.
Right. So that's going to be an issue, and the question is, well, but the dollar's reserve currency status and everything's fine, and everyone wants to import export their goods to the United States and everything like that. And I'm totally with that. I think that's going to exist for the next decade plus. But there can be a lot of unwinds that create 30% drawdowns in the interim that are going to be really critical to avoid. So that's how I think about that.
Very interesting. Yeah. We tend to think that obviously liquidity, both of us see liquidity as being pretty positive right now in terms of the Fed being overly accommodative, or at least accommodative, right? Like to claim that the Fed is restrictive on forward guidance is, I think you drank the Kool-Aid, but I think that's what we're seeing here with obviously growth impulses super high, real GDP pretty high, growth expectations up. I mean, all in all, this is not something the Fed should allow forward guidance to slip too low on, and how they do that, I think, will really determine the scope of like you said, private treasury issuances, but more importantly, the ability for the private sector to leverage up, right? Like if conditions get too easy and the private sector starts really leveraging up, I think that would be something, in my opinion, that increases the risk of what people want to call a melt up, but more so massive exuberance in a short period of time, right? Where people go way over their skis and then they're way more fragile. And then you end up in a position where recession risk actually rises with the climb of the economy.
Yeah. Yeah, that sounds right to me.
Yeah.
All right. Well, it was good chatting. I think we could wrap it up there.
Totally. Awesome. Well, thanks again, guys. Please feel free to reach out anytime and let me know if anything I can do to help. And I love the direction you guys are going. I love what you guys are doing.
Yeah, really appreciate your time.
Yep.
Yeah, totally. All right, I'll catch you guys later.
All right.
Yeah, see you later.